LCR, NSFR, asset liability management. What is all of that? Tier 1 capital, right? Well, I was also very confused a few years ago when I started working on these topics, and I discovered this is something that you rarely learn on school. Like, you don't go to a bachelor's in accounting or master's in finance, even in the CFA program, and you learn about these topics. You usually learn about them by yourself when you're working on, or by learning from others. But it doesn't have to be that way. I found out there is limited materials. To start with, what is asset liability management? Well, asset liability management is a discipline, it's an art, it's an engineering work that looks to optimize the balance sheet of a bank. And it's important to mention this is very useful and something that you will only see in banks and at some point in insurance. Specifically for banking, basically it's super leverage. So the nature of this business requires banks to optimize the balance sheet. Why? Well, asset liability management, as it sounds, is managing assets and liabilities, basically the balance sheet, in a way so that maximizes returns for the bank. But we also meet all the regulatory requirements that banks have. And when I think about asset liability management, I think about three main components or pillars of asset liability management. That will be liquidity risk, IRRBB, interest rate risk in the banking book, and capital management. And no surprise, these are the same topics that are basically regulated through Basel III Accords. Basel III came as a result of the 2008 financial crisis and also previous crises in history. And just for your context, in case this is the very first time you are exposed to banking as a whole, in 2008 there was one of the biggest financial crises in the world, and the financial system is super fragile. But besides that, there's so many dependencies of that financial system on the whole scheme of things: your job, companies paying others, suppliers paying, making transfers to your neighbor. All of that requires the financial system, and if this breaks, guess what? Well, nothing works. So when banks were mismanaging their assets and their liquidity and their capital, and that led to severe disruptions on the financial system, then the government stepped up, and there was an accord, general, what I call general regulatory requirements for banks to standardize how banks manage these risks. Let's start with liquidity risk, because that is probably one of the most important ones. And when I think about liquidity, I usually think about the short term. There is also long-term metrics, but liquidity is usually the ability, being capable of paying your debts in the short term. Like, if you have to pay something in the next 30 days, are you able to do that? Do you have the cash ready? That's the question that liquidity asks. And there is a further added complexity, that's the stress testing. Banks will usually run internal stress tests, and what they ask is, if tomorrow there is a financial crisis in the same level and speed that what we have seen before, or even augmented because of other factors such as social media and use of electronic channels, can the bank pay the debts, as meet the obligations that they are supposed to? That's the question. And banks need to, and that's the key, that banks need to hold cash and cash equivalents so that they are able to meet the obligations in the short term and in the long term too. But we think about liquidity mostly in the short term, and for that we have something called HQLAs, high quality liquid assets. As the name suggests, they are assets that are liquid, that are high quality, such as cash, government bonds that are from countries that are supposed to be safe, and The idea is that you're able to convert those bonds or securities into cash fast and with minimal haircuts, so that you can take that cash and pay. Or if your clients are coming to you and they are withdrawing, they want their money back, you as a bank are able to do that. That's the question on liquidity. The second question, or the second pillar, is on interest rate risk on the banking book. And interest rate is a very important factor into the P&L of the bank. So unlike other type of businesses, banks require interest rates in the market to price their products, because they don't sell a tangible physical product. What banks are selling is the service of moving your money from one side to the other, helping you with that. They are basically intermediaries. They take money from customers like you and me, and they accumulate all of that money, and they make loans to whoever is needing loans. So they are intermediaries. Someone needs money, this other person has the money, so they channel the money to the bank system, right? And they charge for that. They charge money to the loans as an interest, and they pay depositors as much more interest. And the difference, the gap, the spread between these two is usually the P&L for the bank, the net interest margin for the bank. That's the main source of income for some banks. Other banks that have like investment banking, advisory services, they also charge fees. But essentially, interest is one of the main contributors to the P&L of a bank. So it's highly volatile because the interest rates are moving in the market, right? They depend on many factors, the economy, inflation, you name it. So what the interest rate risk in the banking book is doing is asking the question, if tomorrow we have a sudden change in the interest rates, like it goes from 1% to 2%, 200 basis points, or it goes down, what's the impact? We need to measure the impact in terms of money. What's the impact to the P&L? What's the impact to the capital? Can we afford that? Are we okay with that? Do we have the appetite for that? If we don't have the appetite for that as a bank, then we need to change the asset composition, the liability durations, convexities. We need to move the balance sheet, engineer the balance sheet so that it is efficient in terms of there is less gap, there is less difference in durations, and if you have a benefit in assets, you have an equivalent impact on liabilities that they match. We will go that into more details, but I just want you to think about when we talk about interest rate risk in the banking book code or IRRBB, we're thinking about what is the impact to the P&L and the capital of the bank if the interest rates change by a lot. That's the second thing. And the last is capital. Another problem in the 2008 crisis was, well, as you know, capital is supposed to be a loss absorbing tool. If there is an event in which the company needs to close down, capital is usually used to pay back the creditors, to pay back employees, right, once they have used all of the available cash. And in the 2008 crisis, well, banks didn't have capital either. They didn't have liquidity because they were invested in CDOs and mortgage-backed securities that have not the quality that they were supposed to have. And they didn't have enough capital because they were greedy. And greedy means banks want to have and keep as low as possible the capital, because the business of a bank is highly leveraged. They use our money, your money, my money to make money. They are leveraged. They depend on others' money. They don't use these shareholders' money to make loans. No way. Banks take the money from you and me, from clients or from corporations that deposit money there, and then they pack that money and they prepare that into investments, or they loans, they make a mortgage loans. That is the business of the bank. So they don't use their own money. Shareholders' money is not used for that. So to keep the capital as low as possible is a strategy to make more returns for the investors. And That's a huge motivator. There was nothing stopping them from doing that until Basel III comes, and they require banks need to have a certain minimum level of capital in proportions to their size, because you cannot just mandate and require all the banks in the world to have the same level of capital. Their banks come in different shapes and sizes and responsibilities and also risks. So what the Basel III requires is that banks keep a minimum level of capital called Tier 1 capital. We will talk about that later on other videos, but just think about capital, stockholders' equity, in proportion to the risk that they are taking on their assets, because it's not just the size of the assets. Because what Basel III reasoning is, okay, you have $10 million in mortgage loans, or let's say credit card loans, $10 million, and then you also have $10 million on a US government bond. So what is more risky? Obviously the credit card. So they weight that, they factor in the risk of one asset versus the other, and what they do is they basically increase with some factors we call the standardized RWA approach. We take the assets, we apply those conversion factors to come up with a risk-weighted asset. So it's the asset size, the asset amount, but weighted by some factor to make it more visible or less, depending on how much risk it contributes to the total mix. And the banks are then required to have and hold a capital in proportion to that. That's the tier 1 to tier 1 ratio basically. And capital is required because it's also a tool to absorb losses. So eventually all of these things, and the last message is, all of these things drag returns, because if you are going to hold more capital than you need just to keep these ratios met and to be green check with the regulator, well, that excess cash that you have in the capital in your stockholders' equity could be invested somewhere else. So then you're losing money. If you want to be extra safe on the liquidity front, and you know you have only 100 coming due in the next 30 days, that you have a debt coming due in the next 30 days, is 100 million, but you want to have 200 on cash today just to be extra sure. That extra 100 that you have on cash is making zero money, or maybe very little interest rate, right? So you are also losing money there. You're leaving money on the table. That is trap liquidity. And if you are also adding interest rate hedges like swaps or derivatives to manage your composition of your portfolio to protect against an interest rate swing, that is also costing. Nothing is for free. So anything that the bank will do to meet these regulatory requirements cost money, and it will drag returns. It will drag on the returns of the bank. That's why the function of asset liability management is basically to manage all of these risks, optimize the balance sheet so that we can meet all of the requirements but maximize the returns. That's what we look for, to maximize returns but meet the regulatory requirements. So think about again that map. So you think about asset liability management, think about liquidity, interest rate risk, and capital management. At the center of that is the net interest margin, the returns. So banks want to improve that, we optimize the balance sheet so that we can meet regulators' requirement. But there is a caveat. Sometimes you want to improve the capital front by paying out dividends, but guess what? If you pay too much, you may break your liquidity ratios, or you may damage your interest rate metrics. So sometimes you want to improve one metric and you are damaging the other. So sometimes these metrics are pulling in different directions, and that makes it difficult to optimize the balance sheet so that then you can improve returns. That is the magic. That is the true art of asset liability management, and why I think it's also interesting, and I'm passionate about it, but it's difficult. And yeah, so I think this is for the introduction. We will go into more details on next videos, but this is just a beginner's kind of introductory level to what is coming on and what is asset liability management.